Adrian, as always, so good having you. Thanks for taking the time out. Until last month, Adrian, we were all talking about how India is the highest relative weightage in the EM pack. Now we are hearing that if you look at the April holdings, the weightage of India has fallen a bit as well. How are you dissecting what's happening to the emerging market pack, and where does India fit in within there?
Yeah, we were just looking at the numbers for our core client base. India's relative weighting versus the benchmark hasn't fallen. Its absolute weighting has fallen, but obviously with the underperformance of India relative to markets like China, Brazil, Russia, you will get a change in benchmark weighting. So I think it's too early to say that the consensus has adjusted down their overweight in India.
And Adrian, you would say that this move on India is definitely in relation with how other markets like China, Korea and Taiwan are doing, because China is already now sitting at fresh highs.
Yeah, I think it's very important to understand that what a portfolio manager is trying to do on a global basis is to maximize their return and to be in the highest return markets. And we often mistake foreign selling as a statement about a deterioration in fundamentals in the market where you're seeing the selling. It may reflect that there are better opportunities elsewhere rather than a local negative.
Adrian, the basic ledge on which Indian markets have rallied is the political mandate. We have a stable mandate. But if I look at the market behavior, the leadership groups are still pharma, consumer name and FMCG stocks. So if the basic push factor for India is a stable mandate and an economy which could come back, why is the market behavior so different?
Well, I suppose it depends on what time period you're picking. Initially when the government came to power, you did have a rally in deep cyclicals, including late cyclicals like construction companies, engineering, and then we saw that sort of hope rally pulling back. More recently, the macroeconomic data has been disappointing if you look at industrial production or PMIs, and therefore it makes sense that investors would rotate more into defensive sectors.
The fact that US economy is making a comeback, the Fed is confident that US economy will improve further. What will that do to IT and pharma and textiles, large groups which derive lion's share of their business from US markets or US economy?
Well, I'm not sure if I agree with this idea that the US is coming back. If you look at the first quarter numbers, the US economy contracted. The more recent non-farm payroll has shown a decrease. It has shown less of an increase in the non-farm payroll than the previous months. So at this point in time, confidence in the US growth story is relatively low. If we listen to what the Fed is saying, they're watching the data, and the moment the data suggests that the Fed should remain on hold. And with regards to demand, I think demand into the United States for imports still remains very lackluster. European economy is expanding, but only at 1.3%. If you then adjust for the value of the euro, effectively imports into Europe are contracting as they are into Japan. I'm not a big believer in the export story. If you're going to be buying countries, you better buy it for the domestic growth dynamics.
Adrian, since you talked about, India's underperformance vis-a-vis the other emerging markets linked to external as well as domestic factors. Now, it seems like the Shanghai markets are not coming down anytime soon. They're already at a 7-year high as I speak. But what about domestic factors? What would have to change for the India inflows to actually improve?
So I think there are a couple of things that people are focused on. The first is how effective the government is in spending money. Remember that the big budget for Modi was only announced in March, being implemented in the current fiscal period. So we'd like to see the effectiveness of that. We're also watching high-frequency data such as auto sales, and those have been improving from low levels. Maybe a slightly different picture with two-wheelers. If you look at heavy commercial vehicle sales, those are also expanding as well. So I think the consumer and maybe even the corporate is perhaps a little bit more upbeat than some of the data such industrial production and PMI suggests. So as India picks up steam, inflation remains moderate, Perhaps we get another cut from the Reserve Bank of India. I think it's all these sorts of factors that are going to help investors' confidence. And certainly when I talk to clients, there are now long lists of stocks that they're interested in buying. They may not feel there are immediate catalysts for those, but I definitely think there is an attitude that this is the right level to add to risk. If we've got the option to do that, and obviously there are investors who don't have the option because they already have large exposures in India.
Adrian, whereas the MAT issue clearly has got this government a lot of bad PR and global bad press, the finance minister today told ET Now yesterday that we should not blame the current government for the MAT debacle. It is a legacy issue. They've come out with an explanation. They have put a panel in place. Do you think global investors are satisfied with the response?
The MAT issue is an Indian issue, regardless of which government's in power. The current government has the ability to address it, so maybe that's why investors are looking to the current government. But it's an India issue, and who's in charge at the moment? Well, it's the current BJP government, and it would be helpful for India if this issue was addressed.
Adrian, let me get to you on this because I remember your earlier response to us, wherein you mentioned that you've been investing since 1994. These issues have come up time and again. They haven't unduly bothered you.
Yeah, I think you are used to ambiguities around taxation. There is ambiguity in investing in quite a number of emerging markets. I don't think one should try and be the lowest common denominator here. It's always good to reconcile these issues.
Fair call. So we got your point. We leave it at that. Now let's talk about the two big things. If you haven't spoken about them already, Adrian, excuse me if I've missed out on that. But the two big things that people are watching out for in the month of June, one of them is the rates, the other one is the rains. And both of them for now seem to be on course. What are your expectations, if any?
Well, it's difficult enough forecasting equity markets. Trying to forecast the weather in equity markets is always very hard work, very low probability events. Let's just wait to see what happens with the rains rather than trying to take an investment position in place. With regards to rates, we would look for the RBI to do something within the next month or so. We've had inflation below expectation and also a relatively weak IP number. Those would seem to be a good environment for further cuts in interest rates.
Adrian, you just talked about the fact that, your clients are getting back to you with their list of names that they wanted to put in money in when it comes to India. And we also just chatted about as to how defensives are finding favor in the Indian equity markets. What's that wanted list now that valuations as well have petered down? What's looking attractive in the market?
Yeah, so it would be things like the near cyclicals, such as the banks, which have come off, building material companies, some of the consumer names, including the auto names. So these are the type of ideas that are coming out from clients, as well as commercial vehicles.
When you say banks, would it be fair to assume that it doesn't include the PSUs because that's where one continues to see asset quality risk? Would you stick it with the private sector banks?
No, I think it's a broad statement across banks because you do tend to get a very big discount with the PSU banks. The bigger PSU banks are also quite good deposit-taking institutions as well. So I would argue it would be across the board.
Adrian, let's talk about the other big sector, which is the energy/oil and gas sector. A regulated sector, but it's quite heartening to see that the diesel prices and petrol prices have been decontrolled totally. The fact that diesel and petrol prices were increased in the month of May twice when global crude prices went up, that means that government is supporting the spirit of decontrol. Would you be advising your clients to buy into some of these stocks now?
Well, I certainly agree that it's constructive that we are getting the test that there is price control, and you only get that test when the government has to raise prices. We're perhaps seeing Indonesia doing less well in that test at this point. So it does reflect well on the government. I don't have a particularly strong view on the refining and marketing companies. With regards to petrochemicals and refining margins, those have been reasonably good and looking out, maybe we've seen the best.
Adrian, just wondering, in the morning we were talking about how some of the new age sectors are getting valuations which are unheard of, and the opinion is divided right down the middle whether one can invest into these companies or no. Somehow the Indian .com, internet, e-commerce companies seem to be making some bottom line numbers, some real gains out there. Any of the new age sectors in India or the emerging market pack that look attractive to you? It could be e-commerce, it could be defense in India, it could be railways in India. All of these are very, very small right now though.
Well, clients are reasonably familiar with these sectors. 10% of MSCI China is e-commerce companies. When you get the ADRs in the US included, China's index will become 20% e-commerce. So investors are used to investing in these companies. They've had some very strong success stories. You have a derivative of investing in e-commerce by buying one of the larger companies in South Africa as well. So investors are very interested. Many investors do have the mindset where they're willing to buy into the high revenue growth story that is yet to report profits, with the expectation that a few of these will be multi-baggers.
Adrian, but in general, Indian mid-cap stocks now are trading at a premium to large-cap stocks. Is it time to recognize that the value in Indian mid-cap stocks is now missing? You can always find 10-15 stocks, but in general, are Indian mid-cap stocks now priced to perfection or even overpriced?
I think the problem with that calculation is you need to adjust for sectors. You don't tend to get banks in the mid-cap, nor energy stocks, which are the lower PE sectors, whereas mid-caps often have more exposure to consumer, perhaps even to e-commerce, and those tend to be higher P multiple sectors. So it's important to do this on a sector neutral basis, and I don't think there is that big a difference.
The theme for us on the channel in last 10 days has been we are trying to analyze the first year of the current administration. So if you have to, let's say, make a quick scorecard of what this administration has achieved and where it has failed, why don't you make that quick scorecard for us?
Yeah, the most important achievement for us is to bring down inflation, particularly controlling the increase in minimum support price. You know, what economies want is low, stable inflation, which gives you low, stable cost of capital. I think that has been achieved. There were a number of serious issues, particularly with regards to the availability of coal, with regards to the mining licenses. Those are being addressed. I think this is a story where the government inherits an awful lot of problems and is gradually working through those problems. We have seen some legislation passed. Probably most important for the financial community is a larger foreign ownership limit for the insurance sector. Remember also we had the merging of the foreign ownership limit between FDI and FII. That is clearly very helpful, particularly for those stocks that were at the high end of their FII limits. So I think there has been a lot of progress. Clearly some near-term disappointment that GST was not passed, nor the Land Acquisition Act modification in the most recent session of Parliament. Let's hope those committees can address the disputes and perhaps we can make some progress. Now, with regards to the economy, I think we've seen this in many countries where you get a new administration coming in, a lot of expectation, but it takes time for that administration to get in place the right people, to agree the right procedures, to be comfortable in increasing budgets. And the result has been, whether it's Mexico, Indonesia, even China, that you've had a disappointment in the first year, and that disappointment eventually disappears as we start to spend and make an effective progress over the balance of the administration.
So, Adrian, your pitch clearly is that bet on the recovery, bet on the fact that Indian economy will bounce back, demand will come back and operating leverage would kick in.
Yes, I would bet on that. Just manage your expectations and also remember that you're in a very low growth world. So If we're right, India's growing at 7%. That's still a very high number. We're finding plenty of companies in India which are generating good double-digit top-line growth. So manage your expectations, but we certainly do expect growth to be accelerating into 2016.
Which are the other key sectors or themes one should look at investing in, assuming that good days are just about started?
Yeah, so the other two sectors would be commercial vehicles and building materials, specifically cement. The feedback from our real estate analysts is that we are seeing good pickup in volumes in terms of sales. And so I think behind the scenes, there's a little bit more going on than perhaps the market understands.
Adrian, always a pleasure having you on the show. Thanks so much for taking the time out.
Thank you.